What are the self-dealing rules for nonprofits and QRPs? I'm going to add in there IRAs as well. So when we talk about a qualified retirement plan, we're really talking about 401K and 401A. And this is going to dovetail in with one of our other questions that came in off the internet as well. But here's how it works. If you are in a particular type of entity where it says you cannot interact and engage in business with a disqualified person, you could not sell them $1 million building for $1. It is an absolute prohibition against self-dealing. And so that's the most important first step, is determining whether or not you're within one of those rules. Then if you are, then you look and say, are there any exceptions to that rule? So for nonprofits are going to fall into broad categories. Foundations, private foundations are one. These are nonprofits that aggregate money and give money to other nonprofits. They don't do anything. And in that one, you have an absolute bar from self-dealing. The next one is a operating nonprofit that is doing something. And in that case, you just have to use arm's length transactions. So we look at that. That's our step number one. So let's go back to the first one, private foundations. Then you look and say, are there any exceptions? The only exception is reasonable compensation. You can always be reasonably compensated. But other than that, no more transactions. So for nonprofits, 501c3s, you can enter into transactions as long as it's an operating nonprofit. It can give you benefits, it can pay you, and it can engage in sales and other transactions between you and it, so long as they are arm's length. And the way you make sure it is arm's length is you have non-interested parties looking at it saying, hey, that looks okay to me. Somebody who's doesn't have a dog in the fight. Now we go to QRPs and IRAs. In either one of those, you have absolute prohibitions against self-dealing with disqualified parties. And disqualified parties are lineal descendants, which would be grandparents, children and their spouses, great children and their spouses. It does not include your siblings. So what's interesting is you could actually engage in transactions with your IRA, for example, and loan money to your brother. You cannot loan money to your mother. You could not loan money to your kids or your grandkids. You could not do a second on their house. You could not do anything between the company. You could not buy a house from them. That is an absolute bar. That's called a disqualified party. Go ahead.
And the way I kind of look at it as to whether you may be violating self-dealing rules is, are you benefiting from a transaction between you and the nonprofit or the QRP or the IRA? Mm-hmm. And that's really what they're out to prevent. And unfortunately, the rules are pretty severe for violations of the self-dealing.
If you self-deal, you're just going to disqualify your IRA.
Yeah.
If you're using a QRP, using a 401K, then we have different rules. And in that particular case, it will just disqualify the money that you actually were utilizing. They're far more lenient.
I had a client who had a QRP, it was actually a defined benefit plan, who had a required minimum distribution to make. And the plan was not funded at the time. So the client had to make a loan to the QRP, which is a self-dealing. Mm-hmm. But fortunately, there's an exception for that the loan was quickly repaid. There was no profit or interest earned on it.
Was it within the 60 days?
I believe it was within 60 days.
So they just used it as almost like a rollover. There's some more fun stuff. So then we go into the 401K's, and this is where you get into people acting on behalf of the company. I know that there were some questions that were already posed in the chat feature here. But if you're not supposed to be getting any personal benefit or using those funds at all when you have an IRA or a 401K. In an IRA, it's much more severe because you have a custodian. So If a renter, for example, is paying you money and they pay it to you individually, technically you have a violation of the self-dealing rules because you just received money. Even if you go ahead and put it right back in the IRA, you're going to have an issue because technically you weren't supposed to be receiving the money. The custodian was supposed to be receiving the money. So you should actually have rental money going back into going to your custodian if you're using an IRA. If you're using a 401K or a 401A, which is a profit sharing plan, or a 401K, then you are the trustee and you're able to accept the monies and endorse it right into the account and make sure that the money goes to the right place. IRAs are a little more difficult. So to get around this, a lot of people with IRAs will set up an LLC, which you can be the manager of. You're actually, the IRA is technically the member, and you're in a non-compensated role. And we have to make sure that the LLC agreement says that. If we drafted it, then we make sure that we're putting in the non-prohibition rules. You cannot personally benefit from any of these activities. It has to all go back to the retirement plan. So people will do the LLC, and they will be, all right, now I can go ahead and accept the funds through the LLC. That's how they do it with an IRA. If you're doing it with a 401K, we're going to suggest that you still set up an LLC anytime you have real estate, just because we don't want the liability to flow through to you. But there, now you don't need the custodian. You could technically do it inside the 401K directly, although you should still have the LLC. And it's the same scenario where you're able to accept the proceeds. That's not going to be a technical violation because you are acting on behalf of the plan. And that is not a violation of the self-dealing rules. So the biggest takeaway from all this is that you can act on behalf of a plan. The second a disqualified person starts to get personal benefit, you have violated the rules. And if it's an IRA, the whole thing is violated and considered a taxable event, which would be the 10% penalty plus income tax on it for the entire amount. And if it's a 401K or a 401A, it would just be the portion that you violated. So, we tend to be very bullish on using 401Ks and 401As, the profit sharing plans around here, also known as a QRP. And this is why, because they're far more forgiving and they have less moving pieces.